returns since our last video, which was about a week before Thanksgiving, is interesting, and it's also sort of what we highlighted as something that could happen or was already in the process of happening, which was the high-flying tech names and indices getting a little tired. Not that they were about to roll over and crash or even have a major correction, although we're maybe starting to see that in some software names, but that there was some strength that was happening without really getting much attention from certain sectors like energy, consumer staples, healthcare. That has continued. As far as how is that showing up in our client conversations and in portfolios, it's more of the same. You know, it's not a very exciting answer, but it's a little bit more of the same. I think we sort of started preparing for 2026 a month or two before the end of 2025, which was to make sure that people had exposure to these other sectors, or they had adequate diversification to their portfolios, because tech, you know, there's an expression, trees don't grow to the sky. You know, there has to be a break in the action for these technology names. And I know that some have continued it, specifically with certain chip names that are direct beneficiaries of this AI trade, but even that's not going to continue. So to answer the question, I think we're just really happy with what we're seeing in terms of some of these sectors and industries that are associated with the real economy starting to perform. Homebuilders is another one that we mentioned in the last video, and we're starting to get some traction there as well. So we are having a lot of client conversations and meetings where we're reviewing 2025 and, you know, sort of talking about what to expect in 2026, which is always a little bit of a crapshoot. It's a guessing game, but what I am noticing is the tone is like, okay, great, last year was terrific. How can we make sure that this year is just as good, if not better? Which you can't blame clients for thinking that way. You know, it's exciting to make money. But that is interesting because there's sort of a lack of fear or even caution. And we're talking about clients that are in their 60s and in some cases 70s who are asking these types of questions. You know, how can we really capitalize on this obvious continuation of the bull market? And that just, it gives me pause for obvious reasons. You know, first of all, April was 8 months ago that we were in the grips of absolute panic, where there was virtually no visibility on what was to come next. Nobody knew what this tariff situation, are these the real numbers they're throwing out? That's going to torpedo the domestic economy. And people, for a week, people couldn't look at their portfolios. And here we are 8 months later. Not that much has changed. You know, there's still uncertainty. Of course, we've had 8 months worth of inflation and economic readings, and all looks okay. But the market is significantly higher, and I think that's just it's polluting people's views of what's likely to come. So I'm a little bit more nervous than clients seem to be. To me, it's a fascinating divergence, the fact that oil is down 20% over the last year and energy stocks are up. They're not up as much as the broader market, but they're positive in the face of falling oil prices, which is interesting and counterintuitive. And there's, I think, a couple things going into that. One is expectations of what's to come. So these stocks are trading based on not necessarily where oil is, but the direction of change of oil prices. And I think the expectations that oil is closer to reaching a near-term bottom than top. You know, there's upside in oil prices. And these companies are also a lot leaner than they were 10 years ago plus, because there was the whole disaster from 2014 through 2018 or so, when oil prices were very low. Saudi Arabia turned on the taps to basically wash out shale investment here in the United States. It worked, and a lot of companies went out of business and were absorbed by the surviving companies, the bigger energy companies. And so all that debt got wiped away. So the companies that are still operating here are stronger in every way. They basically absorbed the smaller companies that had to declare bankruptcy, and the debt's gone. So they've taken on all this new shale technology that existed and without the debt. And here they are operating with oil not high enough really for them to make a ton of money, but they're above their break even. So any upside to oil prices from here is going to really, I think, turbocharge these companies. So you're seeing those stocks. And I noticed that late last year, energy stocks were doing pretty well, despite the fact that oil was kind of like just dripping lower and lower and lower. And what was really interesting last week with all of the Venezuela commotion, every headline sort of implied that this is going to be terrible for oil prices because so much more Venezuelan oil is going to all of a sudden come online. It didn't take 48 hours before that became an obvious error in judgment. The oil's not going to come online anytime soon. And oil didn't even trade down the next day. So that was a Sunday that Venezuela was invaded, and then Monday oil prices were flat to up a little bit. So to me, that's something to take note of. When there's a big supposedly bearish headline and the stock or security trades the other way. So I do think that we've seen an inflection for energy prices. And we have a little bit of exposure to energy stocks, and then primarily we get exposure through the pipelines, the MLPs, which are a great tax advantage way to take advantage of consistent and rising energy demand, both oil and primarily natural gas here in the United States. I simply don't know. I can talk about it with a bunch of questions, really. And I think your assertion that gold and precious metals in general are the new crypto is accurate. Just as far as watching who's participating and who's getting very excited about it. I feel fortunate to have a little bit of exposure to gold and precious metals. This is a once in a decade move, what we're seeing in silver in particular the last couple of weeks. It's I don't know that there is anything rational to explain it. It's not supply and demand for the actual metal. There's a supply and demand for the securities, which drives up the price. But in the past, we've argued that gold gets confused as it's an inflation hedge, it's a deflation hedge, it's a hedge against the dollar losing value or reserve status. None of that's really happening. We're not seeing, inflation is tame. We're not seeing deflation. We're not seeing the dollar implode. It lost 10% last year, but it's now stabilized. I think it's sort of an uncertainty hedge is the best I can explain it. Maybe it's people thinking that we're entering into more dangerous war times. There is a lot of talk of that, and I know Iran's in the headlines now, and there's skepticism that we may be getting involved there. I don't know if that means that gold deserves to double in a year, but that is what's happened, and I think I sort of look at it similarly to the way that we were describing tech stocks. It's not going to continue forever. Is there more upside? It's very possible. My guess is that the bulk of the move is over. A catalyst to the upside would be problematic. What could it be? It could be economic growth picking up or inflation perking back up, which I suppose if oil does in fact rally quite a bit from here and energy costs go up, that would be one factor. Food prices are being stubborn and not coming down, so that's a positive contributor to inflation at the moment, not in a good way. That would be one thing that would drive rates higher, or at least put upward pressure. A catalyst for them to move down would be bad news economically, would be a good thing for interest rates, and it would give the Fed cover to start cutting again or cut further, more aggressively. The short end of the curve is low. It's in the mid threes, but it's the 10 and the 30 year that are in the low and high fours respectively. And that's what housing is really looking at. So I don't know. There's only so much outside influence that the administration or the Treasury can have on interest rates. It's really supply and demand for our debt and growth and inflation expectations. So it is interesting that we've sort of been hanging out at these levels for a few months now. I think that's probably a good sign. It's like the move down that we experienced in the back half of last year is sort of just getting digested, and I think that's a good thing. GDP is sort of in a little bit of a zone. Inflation is in sort of a zone. It's it's not falling down to the floor where such that the Fed can cut rates back down to zero. Everything is sort of coasting a little bit, and yeah, I think the yield curve and interest rates, especially the long end, they're looking for something to happen before deciding what to do next. There's a potential change in market leadership that's already underway that's getting virtually no attention. What we are seeing when you read headlines or you get the notifications or you turn on the TV, it's usually tech, or now we're starting to see precious metals highlights. These are the things that have gone parabolic, and it's exciting, and that is what retail traders think that they can make quick, easy money with. What I'm noticing, and what we're taking some action in, is making sure that investors are diversified, which people hate to hear that because it's so boring and everybody knows it's what you're supposed to do. But when there is a change in leadership like we've seen, it really requires action, because you have to take profits from the former market leaders, tech and precious metals, if you're lucky enough to have an allocation there, and rebalance into some of the things that are now starting to turn positive, which people have forgotten about and they find boring. Consumer staples is boring. Energy, come on, I thought we were all moving on to EVs. Healthcare and home builders. People just don't talk about these things. They're not exciting. They're boring businesses generally, but they're making money. And they're coming out of a multi-year period where they didn't do a whole lot. So there's some catch-up to happen with these industries and sectors, and we're making some changes to make sure that investors do have exposure to some of these areas with a margin for safety. In a lot of cases, really healthy dividend yields, higher than investing in cash alternatives or T-bills, and reducing tech. Even though it's counterintuitive and you sometimes have to talk people into it, your tech exposure should not be 30% or more, especially if you're approaching retirement or recently retired. So be thankful that you got some incredible performance the last couple of years, and now do something about it.